macroeconomy is facing after a year and a half of the COVID pandemic. Clearly, we've seen a strong recovery in economic activity this year in most countries in the world, and to a certain degree also at the beginning of a normalization in policy stimulus, but I think it's fair to say that there remains a lot of uncertainty in the world economy. In the short run, we are concerned about the spreading of the Delta variant in the face of very unequal vaccination rates around the world. Also, we are unsure if the current surge in inflation will be temporary or more persistent. In the long run, there is concern about whether the unprecedented rise in public debt will pose problems for policymakers and the economy at large, but also whether there are any long-run effects of COVID that we can't predict right now on the structure of our economies. So on the background of this, I'm very happy and excited to discuss the resulting policy challenges with four eminent economists. To my left here, I have Agnès Bénassy. She is my colleague. She's part of the PSE squad, but last year on the transfer market, we've loaned her out to the Treasury, where she is now chief economist. To her left, there's Olivier Garnier from the Banque de France. He is Director General for International and a member of the Executive Committee at the Banque de France. On the screen, we have Sebnem Kalemli-Ozcan from the University of Maryland, whom many of you have seen before. And finally, we have Ricardo Reis from the London School of Economics. I'm looking forward to a lively and not too formal discussion with, preferably shorter and many statements. And so let's jump right in. I thought before we talk about the policy challenges, we might just think a little bit about the state of the macroeconomy and what COVID has done to it. So here I'm interested in your views on the current macroeconomic conjuncture, but also in what COVID has done to what we call the state variables of the economic system. How has COVID changed things like balance sheets, but also labor markets and demand patterns? And clearly, the rise in public debt will be part of those things, but that we can perhaps talk separately later. So why don't we just go around the rooms, starting perhaps with our online guest, Sebnem.
Okay, can you hear me?
Very well.
Okay. So again, this first question is about the state of the macroeconomy. So I'm not going to say anything about the policy yet, which is, I guess, going to come after. But in terms of the state of the macroeconomy, global economy, from a global perspective, what did we learn is exactly Olivier put. It goes into two buckets, right? The short run and the long run. And the very immediate short run is about demand and supply. But when we say demand and supply, we really have to think this in a very uneven and heterogeneous way. So it is not just there was an aggregate demand shock and an aggregate supply shock. Now demand is normalizing and the supply shock is also improving, and that's that. It is definitely not like that with COVID. With COVID, there is going to be this sectoral heterogeneity and countrywide heterogeneity. This is even before policy. So I'm taking a stand here before all those fiscal and monetary stimuluses, before policy. So the world we started with COVID, there's a supply shock and a demand shock. Supply shock can generate more of a demand shock, this Keynesian supply shock idea. This is going to vary by sector, and this is going to vary by country. And there's going to be an implications in terms of the global economy, in terms of how those sectors and countries link through the I/O networks. I think this is the biggest short-term lesson from COVID, from a shock like COVID. And in the short run, we are going to keep living with it. That's what is relevant for inflation debate. And these, temporary or maybe can last to a medium run inflation issue. But that's very much coming from the fact that demand normalizes differentially in different sectors and different countries. And supply constraints are also, normalizing differentially in different sectors and different countries. This is, of course, going to be a function of policy, but even before going there, when we just think about the short to medium run effects, this is where we are. I mean, it is a health shock. So obviously this differential timing across sectors and countries, because the health shock manifest itself differentially is very important. And that's how we link back to Delta variants and the vaccination gap among rich and poor countries and so forth. I think we are going to live with it for some time. I mean, let me tell you one very, very important anecdote here. In January and February, we were talking about supply bottlenecks. And a lot of the economists and policymakers said this will be gone by September, October, which is where we are now. The CEOs of the global supply chain companies and shipments, they say, no, this is definitely not going to go away in 2021. And now where we are where what those people said, not the economists and the policymakers. So I think it's very important because this is not going to be like same on everyone, on every country and every sector. And the policy differences and the vaccination difference is going to, can smooth or amplify this effect. So this is something we have to live with it in the short to medium run. So when we talk about, price changes, so and all those things.
Paris School of Economics.
Thank you, Sebnem, and that obviously also links nicely to your work you presented and some of the other papers that we've seen this afternoon. And yes, would you want to share your view about what COVID has done to the world economy?
Okay, thanks. So when I moved to the Treasury in June last year, the first task I was asked to do was to revise the assumptions concerning potential output for the next 10 years. Easy task. So I called several friends, including Ricardo actually, and to ask what you think about potential growth. It was extremely difficult at that time. And so because at that time, so we thought that there would be a hit on investment, not just due to the crisis itself, but also due to legacy debt in going forward. We thought that would be a major hit to labor markets. Hence, as we know, when you break the matches on the labor market is very long, and there would be reallocations, probably reallocations across sectors and within sectors. And we thought also that looking at past crises, that it would be a hit on productivity. And then what have we observed? So then we revised the level of potential output, but not the growth rate. The growth rate during 2 years, so that the level goes down. And we thought that maybe it would be a little more than minus 2% on the level, which is less hit than after the previous crisis. And that there would not be any long-term effect on the growth rate. Now, this time, what we have seen over these 18 months is first that investment has resisted very well. Normally, you have an elasticity of about 2. So when GDP falls by 8%, you expect investment to fall by 16%. And this was just 1 during this crisis. And one reason is the resilience of ICT investment. And now there's a very strong rebound with an elasticity of 2. So investment is going very well. Corporate investment is going very well. Balance sheets have been protected. So the net debt, probably Olivier will give numbers from the Banque de France, but net debt has not increased much in the corporate sector. Of course, there is a lot of heterogeneity. So we are quite positive about the resilience of capital. That will not be a fall in productive capital. Then there's the labor, and the labor is surprising on the upside. The employment rate of the youth is already higher than pre-crisis, and these are not just limited periods of work. It's also long-term contracts. So of course, there has been a huge public support. So the labor matches have been protected, and maybe this is the reason for the very strong rebound. So here also we are surprised on the upside, and then we are left with productivity. And here it's really difficult to guess. So you meet all kinds of people. Some say that it's going to be a fantastic increase in productivity due to the acceleration of digitalization of the firms. Other people are much more pessimistic, pointing to the reallocation of activity, of labor, but also activity at large, and with perhaps a higher share of relatively low productivity activities. And anyhow, there's going to be a structural change, and structural change is long, and in the meantime, productivity may fall. What we've seen with the data, apparent productivity is well, no. The productivity of mobilized work is quite stable, but then we don't know, because there is this short-time work. These short-time work measures that allow maybe low productivity people to stay out. So we really don't know. The fact that we are surprised on the upside for employment may be a sign that we may be surprised in the downside concerning productivity. But maybe we can get both. So this is where we are today, and I cannot say more than that.
Thank you very much, Agnès. Let's go to Olivier.
Yeah, just to complement what has been said by Agnès. So now we are 18 months after the beginning of the COVID crisis, and with the benefit of hindsight, what can we say about the scaring effect of the crisis? And in my view, there are both positive and negative surprises. On the positive side, just it's exactly what has been said by Agnès, is that 18 months ago, or even a few months ago, many people were afraid of a kind of tsunami of bankruptcy, corporate bankruptcies, and clearly it's not the case in France, but I would say even in other countries, I think the fears have been excessive. Maybe it's due to the fact that the relief provided by monetary and fiscal policies has been effective, so maybe at the expense, of course, of public debt, but clearly we have a positive surprise. That means also that the impact, some people were afraid of the impact on the bank sector related to a wave of bankruptcies. So now I would say we can rule out this scenario.
So let me jump in. You're not afraid of the time bomb that Sebnem was talking about earlier?
No. And on the other hand, I would say the negative surprise is that the disruptions in supply chains and also the change in the sector composition of demand are maybe larger and more persistent than what we were expected. And of course, then there is a question for a central banker, the possible impact on inflation. And in that case, you have a combination of transitory and permanent factors, so that's why it's difficult to analyze, because it's somewhat mixed. On the one hand, you have transitory factors with, of course, you have base effects related to the U-turn in commodity prices. You have also bottleneck effects due to the, as it was said, by the reopening of the global economy against the backdrop of low inventories. So this is for the temporary factors, but there is an uncertainty about the timing of those factors. We are still waiting for the peak, but it's not yet there. And then you have more permanent factors, but in the permanent factors, you have to make a distinction between two kinds of factors. On the one hand, and you see that maybe in the labor market, you have some kind of relative price adjustment. Maybe due to the fact that there has been a shift in the composition of demand. You will see in some countries if you want to recruit people for restaurants, you will have to pay higher wages. But this is a kind of a one-time shift. It's more a relative price adjustment, and in terms of monetary policy, you have to look through. But at the same time, with the closing of the output gap, with what we see in terms of inflation expectations, where we see that inflation expectations are going up, maybe we will see also some kind of second round effects, and that means that underlying inflation, and it's exactly what is incorporated in the forecast that has been recently released by the ECB. Over the medium term, inflation is going up. So from the standpoint of monetary policy, it is welcome because inflation was too low, but at the same time, of course, you have to make sure that expectations remain well anchored. And this will be I would say, the challenge for central bankers.
Thank you, Ricardo.
Very good. So I think I'll group the main lessons, as you asked, or the state of the macroeconomy changes, into two headings with a few subheadings. And the first one that I would highlight, also as a complement to what was said so far, is the fragility of globalization. It's just striking how quickly, even though we have relied on open borders for the mobility of labor, of goods, of capital, and in what seemed to have been an unending process that can go certainly until the 1970s, if not World War II, how quickly borders close, how even today in the United States, supposedly the country that welcomes immigrants, it's essentially impossible to immigrate to the United States for now, 15 months, and no urgency in the debate of reopening that border for someone to move into that country. How quickly borders closed when it came even within neighboring countries, when it came to the supply of essential goods. And very related, how quickly borders closed, disrupting supply chains that are even essential. I think that is a lesson that is an important reminder, in particular because it reminds us of the 1930s and 20s, when after 40, 50 years of globalization, suddenly we had a big retrenchment that lasted for many decades. Some would argue even towards the 1970s. But I think this comes as a reminder of that, of how fragile the globalized world, which in my view has brought so many benefits in terms of the reduction of world poverty, in terms of improvement in efficiency, and even equity in the world economy, and how incredibly fragile that is. And then, and beyond any moral consideration, whether that's a good or a bad thing, it's how that implies, therefore, that the search just for lower cost when it comes to a firm optimization problem must now take into account a concern for robustness or risk on account of disruptions in that supply chain. One. Two, it implies that when we're thinking about global development and capital flows, that the lack of cooperation between governments, and especially the still quite appalling way in which advanced economies are hoarding vaccines, which are desperately missing in poor countries, leads me to change my state of the economy in terms of indeed our willingness to help towards convergence or to use foreign aid. The emergence of regional blocs and a change in the organization of economic activity towards more independence of regional blocs from others, insofar as that will increase resilience towards future shocks. A fourth one, and one that is very important in many countries, is that tourism turns out to be a very risky business. Tourism seems to be a very attractive business to many economies. It's highly labor intensive. It had a lot of potential. Many countries throughout the World Bank went around advertising, why not invest in tourism? Well, tourism is incredibly sensitive to shocks like this and can really wreak havoc in that economy. So I would say the fragility of globalization and how that affects production decisions by firms, how that affects political decisions in cooperation, how that affects our appetite for multilateralism in solving problems, how does it affect our concerns for what are risky and not risky sectors when it comes to specialization. Second point, the supply side of the economy, and some surprises in changes in what the supply side of the economy is. And on an optimistic side, how remarkable it is that the production side of the economy was able to close down for a few months and reopen as vigorously as we're seeing it reopen. Turns out that the scope for intertemporal substitution, if you want, is much bigger than what I anticipated, for sure. How, like in Sebnem's work that she was showing, how this has not come with the wave of bankruptcies, Olivier was also mentioning that. Just our ability to indeed, the resilience of the production side is one that, after years of talking about hysteresis, I did not expect to be quite as large. And secondly, also in the financial sector. I think we came out of 2010 with a perception that the financial sector is extremely fragile and that any shock can make it collapse. And we have had a dramatic shock to the real economy. And as far as I know, not a single bank all over Europe has failed. It's quite remarkable if you think about it. Maybe we're over-regulating them, and so they're too safe and thus inefficient. But it is quite remarkable how solid the financial sector was throughout the last year and a half. And again, judging by Sebnem's numbers that she presented earlier, and also by Olivier's words of confidence just a few minutes ago, that probably there won't be that many failures over the next year and a half. that is quite remarkable in terms of the resilience of the financial sector. And so that, I think, changes a little bit, certainly the focus that we've had in economic policy in the last 10 years, in terms of avoiding crisis at all costs because of the fear of hysteresis, as well as the way we're facing the financial sector and the scope for moral hazard. And finally, thirdly, and related on the supply side of the economy, it's this growing role of the government as being an avoider of catastrophes, an intervener of last resort, whether that happens to be in the financial sector or the health sector. It's a very different, I think, state of the world relative to a view of macro policy, a stabilization policy. It's quite remarkable that the great moderation has survived 30 years. It's still there when you look at quarter-to-quarter volatility of growth rates, but it was replaced with almost no volatility in the quarter-to-quarter growth rates, and occasionally every 10 years a massive shock. We went from modeling business cycle as normal innovations to an AR1 process to probably instead Poisson events. That's what it seems like in the last 20 years. Almost nothing happened. Extremely stable economy between 2011 and 19, and then a massive crash. That is a very different perspective, I think, on what stabilization policy therefore should be, and more of a role of the government, of a central bank as another last resort, of a government, or a fiscal authority as an insurer of last resort. These last resort catastrophe, I think, are different. So that's still on the supply side, I think, a different perspective that has emerged from this crisis.
That also suggests that we would need much more discretion of the policies rather than rule-based. Or is it fine to deviate from rules with these unlikely shocks because they have low reputational costs?
Possibly. I mean, you remember the discussions on moral hazard are often, you have to be careful with your timing. There was very little moral hazard in the last 6 months, and I think rightly so, policymakers pushed against or ignored those who said, well, let's not help the economy if there's moral hazard, so far as an unprecedented shock. Having said that, it's in the next crisis, of course, that whatever was done today can create moral hazard in propagating that one or not, right? And so insofar as the shock is always different, sure, then we can think about discretion, ignoring moral hazard, no need for rules. But of course, every time that you respond to one, you do see potential moral hazard for the next one. And given that, I think that those trade-offs will emerge next time, depending on what the crisis comes. More generally, if anything though, insofar as governments, central banks, fiscal authorities and monetary authorities become interveners of last resort, as I was saying, then I think they will push though for an increase in the automatic stabilizers broadly defined, whether those are discount window facilities in a central bank, whether they are social insurance in the part of fiscal authority, because if you are thinking of catastrophic events, then having insurance ex ante, we know, benefits behavior ex ante beyond just saving it ex post.
Thank you. Let us maybe change topic a little bit. So before we look ahead to policy challenges for the future, I thought we could talk a little bit about what we've learned from the policy response to the crisis. Now, I have here written that we should start with Sebnem. Now, Sebnem, of course, has already given us her view about the policy and the efficacy of different policies. I wonder if you could just summarize what you have learned from your work on the fiscal responses across the world, and in particular comparing the US with Europe, where these responses were quite different, what has worked and what hasn't, and whether this is just because there are different constraints or whether we have genuinely learned something that we could apply differently in the future.
Okay, let me also just pick up from where I left off on the first question, because this is extremely important when we want to understand the crisis management and different policies. So I only talk about the short-run view on the macroeconomy of COVID. I didn't talk about the long-run and scaring effects, because that didn't happen on many things that we expected because of the policy. I mean, we should really not underestimate policy. The policy response was tremendous. If you compare the policy response, both fiscal and monetary, to 2008, 2009, and 10, across the world, not just the US, it is like layers and layers more. It's like tremendous response. And that's exactly why when Agnès and Olivier said we expected investment collapse, labor market shuffling and all that, none of that happened because of the policy response. For investment to collapse, you need a financial crisis. Financial crisis didn't happen because of the policy response. For labor, the same thing. Fiscal policy completely kept employment because fiscal policy was like disproportionate, like orders of magnitude larger than 2008. So that's very important. But productivity, what Agnès said, that's the dark side of that mirror, right? productivity is not going to improve out of this crisis because we actually stopped the creative destruction process. I mean, it is great that investment and unemployment issues weren't there thanks to the policy, but because of exactly that policy, we are not going to have productivity improvement. Yes, we are seeing all the startups and everything, but we are not going to see a productive improvement in the long run because creative destruction didn't happen because of the policy crisis. So we have to really realize that. Now, in terms of direct answer to your question, the management, the big story is the fiscal policy, right? I mean, what have been hearings after 2008? Where is fiscal policy? Where is fiscal policy? Monetary policy cannot be the only show in town. Well, fiscal policy is in town. Fiscal policy is basically in every town in an amazing scale and very quickly. What we learned is fiscal policy can respond immediately. It can be effective in the short run. So this is, I think, if there's single most important lesson from policy is this, right? I mean, like these programs, if you look at these firm support programs, they were put together in a couple of weeks. PPP program designed in 1 week. I mean, it's just unbelievable and applied. Same in Europe. Many direct transfers to small firms, pandemic loans, immediately put in place. So in that sense, I think that's a huge success. Now, the downside is that obviously we didn't think about this. We didn't have time to think about the policies, and that's why most of these policies turn out to be inefficient. There are wasteful funds, right? I mean, money went to the places not needed, but still, I mean, that's the best you can do. This is battlefield, and in a battlefield, you cannot do like microscopic surgery. So in that sense, I still see this as a success of fiscal policy. When we compare US and Europe, I mean, they do seem different, but not that different. I mean, the big difference is these, I think, stimulus checks and the transfers and all that in US. And in Europe, the support went in more different programs like furlough schemes, the pandemic loans, and all those other things like moratoriums. Overall, I mean, I think they're all effective. The long run implications might be different, of course. That's probably the topic of the next question. But overall, if you just want to ask what is the most effective in the very short run, right? I mean, that would be definitely the cash grants because you don't have to go through pandemic loans. These are direct help to firms. Direct help to firms. If your aim is, I want to not see a huge spike in unemployment, I want to solve this job problem right away, that's like direct help to firms. To households, the transfer stuff, the checks, that's a bigger question because of who is going to spend that and who's not going to spend that, constraint agents, and we know that very well, and that also differed in different countries. But overall, because there were so many different packages, I think it is effective both in Europe and US, although the timing differs. The timing is definitely going to differ because if you run everything either through transfers, checks to households, or through loans through banks, you are going to stuck there how quickly that banking system is going to process that and who is going to spend those checks. So those are the things that are going to create differences in different countries. And the final thing I want to say on this is the mix, fiscal monetary policy mix. I think this is super important. And to me, as an international economist, this is actually super welcome news because if you work on emerging markets pretty much your entire career, you know that this is the name of the game always. I mean, you always think fiscal and monetary together. In fact, what made inflation targeting successful in emerging markets is that they realize they have to have fiscal discipline and they cannot ignore the fiscal side. They have to use it together. I mean, it looks like in advanced countries now, we also discovered this. I mean, this is a very powerful mix, fiscal monetary policy mix. It can be deployed very quickly and can be very effective, especially when we have issues with zero lower bound. But at the end of the day, that mix is important because what made fiscal even more successful is to prevent the financial side, that not going to a financial meltdown and financial crisis. And that's really what monetary policy achieved. So in that sense, and this is also a global context, right? Global economic context. But then in the other thing we also learned is that this is going back to Ricardo's point, what is going to happen is there bad effects in the long run, apart from the public debt sustainable issues. This whole rush to, exactly as Ricardo said, we don't want globalization. Let's nationalize everything and let's try to find ways of increasing our fiscal packages, because if you're a rich country, you can spend more. And if you don't depend so much on the global supply chain, you are in much better shape. That's the wrong lesson. First of all, you cannot nationalize this stuff overnight, and you cannot end up with a big fiscal package overnight. Here, we have to think this multilaterally. This requires a global multilateral thinking, and definitely I don't think it should be the way to go like, okay, let's just like go and imitate, like we are like islands. Let's try to go back to that world. That would be definitely the wrong question. Thank you.
Thank you very much, Sam. Thanks a lot for these comments. And yes, would you agree with Sebnem that it's the speed and size of fiscal intervention that made all the difference? And coming back to that last point, multilateral versus unilateral, in Europe, of course, there's a strong heterogeneity of the national fiscal responses, as well as a very large, but perhaps a bit late, common fiscal response to the crisis.
Well, it depends on what you label fiscal response, because the emergency measures were extremely swift across the EU area, and there was the general escape clause that was activated very soon, and monetary policy was activity very soon also, and then there were also some measures taken in the banking sector to allow for more lending to the firm. So everything was aligned to produce a very swift response. And we actually, when you compare the profile of GDP with between this crisis and the previous one, is completely different. So of course, the nature of the crisis is different. Here you have a pure exogenous crisis, whereas in the previous case it was the result of debt overhang in the private sector and sometimes in the public sector also. So which we know is it's much longer to come out of it. But here, so I think what you have in mind is rather the recovery package that took time to put in place the Next Generation EU initiative, which is, so it was presented as a recovery package to stimulate the economy during the recovery, and at the same time to transform the economic model to green the growth of the European economy. So as an economist, you are always a bit skeptical when you are presented a tool that both will do the stabilization and also the long-term objective. However, I think these two objectives can be met together. Think about Italy or Spain. They are spending, already now on the NGEU, and without it, they would not have been able to implement a recovery package after the emergency packages. And as for France, 40% of the recovery package was announced before NGEU was agreed on. But it was well underway, so the French government could anticipate that part of the spending could be subsidized by the EU level, so the package could be larger. So it's always difficult to have a counterfactual, but probably if there had not been NGEU, the package would have been smaller. And on top of that, it was designed so as demand-side policies were front-loaded, whereas supply side was more over the longer term. So you have different things into the package, and you can consider that the short-term Keynesian effect, it was front-loaded for the reason you say.
When the next extreme event hits that Ricardo was alluding to, then we will be able to respond to that swiftly with a common policy similar to Next Generation EU, or are we going to be left to the heterogeneous responses of national governments that reflect their idiosyncratic fiscal spaces?
So there are two elements, I think. First is how NGEU will be implemented in practice, and here we have very high stakes, because if it is badly implemented, then it will be extremely difficult to repeat it later on. And secondly is all the question of the level of debt. And so maybe here I differ a little bit from what Olivier said a minute ago, because of course you can have the view that stabilizing the debt is enough, and it could be even better because the R-star is so low, you need more debt in the world to lift R-star. But then the question is when the next crisis strikes, and if it is a little bit asymmetric also across countries, then it may be extremely painful. Well, if you have a large balance sheet, then any event is more dramatic. So you need to reduce the balance sheet to be able to stabilize again for the next catastrophic event. And if it is every 10 or 15 years, you cannot wait 10 years before starting the adjustment. So here, I think we really need to have risk-return analysis and take this element into consideration. Finally, I think the NGU also tells us that a way to do the coordination. So for years, it's been extremely difficult to coordinate fiscal policies. And I'm talking about the fiscal stance. I'm not talking about the fiscal rules. I'm talking about the fiscal stance. Extremely difficult because you cannot tell a country, well, your fiscal stance is wrong, you should do something else. It's the sovereignty of the country, the fiscal sovereignty. And with the NGUs, this initiative came shortly after the new commission had announced the Green Deal initiative. So it was kind of, the money was coming with the strategy, and then all countries could align themselves with this strategy. So whether we can repeat this is, I think it's well too early to tell, because we are at the beginning of the implementation.
Thank you. There are 2 points that came up that I'd like to talk about a little bit later on, namely the debt sustainability issue in the light of Olivier Blanchard's remark and also the policy mix. But I want to give Olivier, Garnier and Ricardo a chance to comment on what Agnès and Sebnem have said and about the lessons from the crisis management.
Okay, look, just a word from the standpoint again of monetary policy. Maybe a specificity of this crisis and the response to the crisis has been from the standpoint of monetary policy, and compared especially with the great financial crisis, is that first, monetary policy and fiscal policies have been complementary during this crisis, and second, that the key objective of monetary policy was to preserve the financing conditions of the non-financial sector. As opposed to during the great financial crisis, the objective was more to support the financial system. And at the end, when you look at in terms of transmission, if you look, for instance, at broad money aggregates, before you had, in both cases, you had a sharp increase in the balance sheet of central banks, but which in the first crisis did not result, and it was on purpose, it's not a problem, but it did not result in an increase, in an acceleration in money aggregates, while this time you had a sharp acceleration in money aggregates and a sharp increase in the deposits of the business sector and households. And so, if I'm very simplistic, and I would not say that in front of a wider audience, but I would say, during the first crisis, it was more QE for the financial sector. This time, it was more QE for the people and for the business sector, of course, through the funding of governments and banks. But at the end, I think it's a key characteristic of this crisis.
Let's move on to debt sustainability.
Okay, let's talk about, thank you, Ricardo. Let's talk about debt sustainability in the light of what Olivier Blanchard has said. And obviously, Olivier, he didn't seem to be very worried about debt sustainability given low real interest rates and the prospect of them not rising much in the near future. Now, Ricardo, you have your own view on debt sustainability, and in fact, you gave it to us in a stimulating lecture for the Chaire Banque de France earlier this year. I wonder if you can comment on what Olivier Blanchard said earlier.
Yes, so let me do that. Let me add a little bit. So first of all, to note that I'm always worried. It's just a personal characteristic. I'm just always worried. And so I will tell you why I'm worried about that sustainability. But having said that, it is important to note that the general thrust of Olivier's comments, I think, are absolutely correct. That I'm not sure probably that is my main concern right now when it comes to the macro challenges, and that certainly the trends in our star and others imply that probably should have more debt and rethink the fiscal rules in the euro area. So with all of that agreement, let me now disagree with some of that, even if only just to make it a little more interesting or informative to you. Let me start with a point which relates to what we were talking earlier about the policy mix and to what my fellow panelists have mentioned. Like Sebnem said, look, it's great. We sent all this money out. It helped some. Much of it was wasted, let's put that way. But what was the cost of that waste right now? Very little. But why was it very little? Because just like Olivier said now, what we did was to all the people who didn't need to get a check, we just locked them at home. And what did they do? They went and saved it. So it wasn't really very wasted money when I sent you a check and you just went and lent it back to me because you put it in a bank who then deposited central bank who then bought a government bond. So that's not really a waste. I mean, in a sense, fine, let's just transfer money between the government and the citizens and back and forth, which is a lot of what we did, as opposed to really wasting it and building some highway in the middle of nowhere. Of course, the cost of it and the waste, but the cost and the waste comes in that at some point, people are going to say, these rising monetary aggregates, hey, I have all this money sitting in the bank, I'd rather go and spend it, to start with, one. And two, the government then has to collect the bonds, and the same way it send you a check, it has to go to you and say, now I need a check from you, in the sense of higher taxes. That's when the distortions comes in, that's when the waste comes. So, let me have a little bit of a more worrying or more sanguine perspective on what happened last year. We haven't seen the costs of the waste of the money. And so, of course, it all sounds wonderful that we have these massive packages, because as of now, people are willing to just give us the money back in some ways. The cost is going to come with the potentially higher taxes in the future. The cost is going to come with the inflation pressures as people are trying to withdraw their deposits. The demand for money is falling, even as the supply of monetary assets is high. The costs are coming now. So I would like to defer the evaluation of how great it was to be incredibly generous in fiscal policy until the next few years. And so I want to add that, let's say, a little bit of water to the fire of the excitement about fiscal policy right now. On the debt sustainability, and therefore very related, some observations. Let me make 4 observations. First, on the R minus G. R has been less than G in the US for 200 plus years. The US has had R less than G pretty much almost always on average over the last 200 years. The US has run a permanent primary deficit for 200 years, compensated by the R minus G, which means that between, if I remember, 1792 and 2002, the US had exact debt to GDP, even though it ran a deficit throughout most years. In fact, if you look at across the advanced economies, since 1800, wonderful paper out of the IMF that show that, look, 2/3 of the years R is less than G. So it's not so much that R less than G is this extraordinary thing that we've never seen before. Rather, it's that that gap has increased. One, but how much does it increase, including in Olivier's plots, by maybe 1%, 2%? What that means is that that says that we can now spend permanently, say, as a deficit, maybe another 1 or 2% of GDP. Not 10% of GDP, not 500% of GDP, 1 or 2% a year. Not in a position where, certainly in the projections of the United States or even in Europe, we're already in a position in which we're running permanent structural deficits that were well above that and where we didn't have that 1 or 2%. So that's what the RG is. It's more of a quantitative, really, than I think that a new, brave new world where you can do brave new things and not pay for things. Second, that the debt is remarkably short in the US, less so in Europe, but in the US it shrank quite a bit, which means that over the next 5 years, and like Olivier was saying, let's think probabilistically, and if we think probabilistically about a spike in R, the impact this will have on the flow of interest payments in the US is actually quite dramatic right now because the duration is just very, very low right now. And so as a result, what has changed in the last 20 plus years, Tobias, aside from the fact that we had this 1% gap emerging, is that there's been almost no spikes. And I have to say this almost with an apology because if you're Spanish or Greek or Portuguese, you have seen those spikes. But on average, interest rates, we haven't seen the spikes of R above G, or they've happened at a much, much lower frequency than we had seen in the previous 200 years. But if they happen, note that actually because of the shrinkage of duration, the impact is actually, the footprint of that is going to be much higher. And where does that nervousness come? It comes precisely from the extent to which, or why would those interest rates spike, insofar as, and I think Olivier also made that point, to what extent can we adjust primary surpluses quickly? Is it the case that if we had a spike in the United States, could we quickly adjust primary surpluses to respond to it, and in doing so, keep the debt stable? Because as important as the coefficient on primary surplus and the debt is the primary surplus on the interest payments, on the total interest payments. And on that, I think, let's see. I'm not necessarily convinced or unconvinced that we now have a lot more capacity to quickly cut spending and raise taxes today than we had 5 years ago or 10 years ago. And finally, And this then, I will do a plug to my lecture here in Paris as well 2 months ago, sorry, is ultimately part of the reason why R has grown below G, and especially below as Olivier showed, below M, the private return to capital into other assets, is that debt has become special. People want more government debt. There's more demand for it. There's a higher debt revenue term or senior term, as I explained in that lecture. But if one thinks about it then from that perspective, from the perspective of that revenue, and you ask what are the fears, what is sustainability, it relies on, can we keep that demand for government bonds there or not? And from that perspective, what are then risks? Risks are, first, inflation. And we are seeing some emergence of a risk of inflation, because debt is very safe insofar as I don't expect governments to default, but it's subject to inflation risk. And so very important is going to be inflation stability in the next few years, precisely to the R minus G. Increases in fears about inflation would be, I think, a main trigger for R exceeding G. But secondly, that if we think that in part this demand for government debt comes from foreigners who want more of this or that debt, then that is a zero-sum game. So let's be careful here, and in particular insofar as there's an increase in, if every single country in the world listens to Olivier and we all push for a higher supply of debt, then very easily that could be balanced, let alone within, of course, the euro area, as we well know. And thirdly, that if the demand for that comes because it has facilitated inter- and intra-generational trade, especially in a context of inequality, well, insofar as policymakers are successful, and they certainly seem very committed today to lowering inequality, well, then lowering of inequality will come with a reduction in fiscal space. If it goes in one direction, it goes in the other. So, in short, one, whether the last year largesse is going to prove to be costly or not is something for the next 5 years. Let's see, it can't be judged just right now. The fiscal policy activism, the cost of it are going to come now with the higher taxes perhaps, with the inflation that follows, let's see. Secondly, and the other comments is that yes, debt can be higher, but the R minus G is not a brave new world. That duration implies that the short duration implies there's quite a bit of risk. And finally, that ultimately the flexibility of primary surplus on the one hand, and two, the continued desire for government debt, neither of which are things that I would take as an absolute given and therefore be as optimistic as, say, Olivier was.
Thanks. I intended to ask a question about the fiscal rules and their reform now to Agnès, but I think we should move on to the policy mix. And there, of course, this rise in public debt is also very important. The role for monetary policy, one may say, is very different in a world where government debt is 100 or 120% of GDP relative to a world where it is 50% of GDP. At the same time, we've seen this rise in central bank balance sheets, which one may think gives central banks more of a fiscal role because they need to decide how to structure these balance sheets, which between government and other bonds, for example, which has fiscal consequences. So I just wanted to ask Olivier Garnier, do you see first a danger of what economists call fiscal dominance, that somehow the monetary policy makers lose their independence because their policies are going to be dominated by the concern of keeping fiscal space and therefore keeping interest rates low? And do you think there is a change, therefore, that will come in the near future, of what the relationship between central banks and treasuries will be?
If you allow me, Tobias, just if you allow me a quick comment on what was said by Ricardo and in the debate between the other Olivier and Ricardo, and maybe to add a caveat also to in terms of fiscal policy. And this is indeed a point that Ricardo made. We had a recent discussion at the OECD also on this topic, which is in the specific case of the euro area, and this is important. If you are a life insurance company, for instance, in France, then you have, as an investor, you have the choice between several public debt denominated in the same currency, the euro. And so you may have a much quicker jump in the risk premium, and as we have seen, of course, during the debt crisis, but more recently, for instance, in Italy in 2018. And this also, in what was presented by Olivier, I think you need to incorporate that, because you may have a sudden shift in the preferences of investors, just a kind of flight to quality, because you may have a flight to the Bund or whatever, and this also has to be taken into account. So I close this bracket, and turning to your question about the policy mix, and maybe on this point, I think it's a way to answer your question. Maybe I would get back also to the debate, the question raised by Agnès to Olivier about the sequencing about fiscal and monetary policy, because indeed it's related to this question of fiscal dominance. And from my standpoint as a central banker, I would say it's more a theoretical question than a practical question, this question of sequencing between the two, because, you know, as for the central bank, when we will eventually decide whether or not to exit and to normalize, it will not be based on fiscal policy per se, about and we will not on discussion with the Treasury, but just about the inflation outlook, and and clearly this will be the case. So far, you know, we are in a kind of currently we are in a kind of a sweet spot where fiscal policies and monetary policies are complementary, because you know, inflation is too low. The key question will be if one day inflation increase and we have to normalize, and in that case, I think the question for us, the question about the sequencing will not be about fiscal versus monetary. It will be more about balance sheet versus interest rate normalization. And we have seen that, for instance, the Bank of England has recently, announced a plan in that direction, combining, a kind of sophisticated sequencing. Maybe the sequencing in the US will be different, maybe in the euro area. But in terms of policy mix, I think at the end of the day, what is important is not some kind of coordination between fiscal and monetary policy. It is more some kind of clarity and credibility about your policy. On the one hand, the central bankers have to announce clearly what is the strategy, what they will do. We have also the forward guidance. And as a central bank, what we need from the part of the Treasury is also some kind of clarity about the reaction function of the fiscal policy, what will be the exit strategy. And in that sense, if I go back to the case of the euro area, a reason why I think it's important to get back to fiscal rules, but revised fiscal rules in the euro area, is to provide this kind of anchor and clarity. If you have in the euro area, in a monetary union, if the central bank has no clear view about what will be, this kind of the exit strategy of the governments and what will be the long-term anchor for debt sustainability, then it could be a problem. So that's why we need revised fiscal rules. We need maybe some kind of, I think from the standpoint of fiscal policy, to have enhanced automatic stabilizers or or more contingent policies, which would give us also more clarity. And last but not least, of course, a permanent common fiscal capacity to address large shocks. And of course, NGAU is a good step in the right direction. But we have to continue in this direction.
Yes, do you agree with that view that suggests that monetary policy doesn't need to coordinate all that much with fiscal policy as long as it's rule guided and the expectations are clear? I remember from our event earlier this year, I think it was in January, where you presented your CPR report on the policy mix that you co-authored prior, I believe, to being the chief economist at the Treasury, that you argued for a more important role for coordination between the two policies, because monetary policy would ensure fiscal space and fiscal policy would ensure the central bank's balance sheet in the case of extreme movements in relative prices, asset prices that might create problems for the central bank.
Okay, so it's a question of vocabulary, because when you talk about coordination of fiscal and monetary policy, you have in view, something like a common loss function or utility function that you would pull together the monetary tool and the fiscal tool and find the optimum in terms of inflation and in terms of output gap. So this is the textbook example. So what we so I can agree that with Olivier that this vision is quite naive and that probably the ECB, although Olivier of course cannot say anything else, but I say it for him, the ECB cannot go into this kind of course the ECB is independent, it cannot do this kind of game with governments, and even less in the EU area where the ECB would be alone facing 19 governments. So what we were arguing in the report actually is very close to what Olivier just said. The fact that monetary and fiscal policy should not be merged because they are more powerful if they stay separate. And to stay separate, they need some credibility, some anchor. So it can be a rule, it can be an institution, it can be something else, but it needs to be anchored. So over the crisis, we've seen that monetary policy has given space to fiscal policy. It has backed fiscal policy in a way, but now fiscal policy needs to back monetary policy. Otherwise, monetary policy will disappear. It will just be an arm of fiscal policy. So, there's a responsibility of fiscal policy to change the rules, to make them credible, and to stop some steps. Otherwise, the space for monetary policy will itself be reduced. This was what was said in the report. So now, of course, the practicalities are complicated, and also I'm still puzzled by the fact that the US and the euro area seem to be following different rules, different routes in terms of normalization of the policy mix, with and probably in the euro area it cannot be done otherwise because of the 19 governments. So if there were only one treasury, it would be easier to think about. And I agree I agree with Olivier in a sense, but in another sense, we know that also fiscal policy has an impact on inflation. So there is a reaction function between the two. So perhaps, of course, there is no coordination per se, but in fact, there is some reaction, and the policy mix is the result of common thinking. So I'm still puzzled. I would be interested to know what Sebnem and Ricardo think about this sequencing of the normalization. And also, I think also one reason to be careful is because we have not talked about that, is the corporate sector, the debt of the corporate sector. So there is excess leverage. So if everybody starts deleveraging at the same time, it's going to be a disaster. And probably we need to prioritize. So when Olivier, Olivier Blanchard said that we should not rush for the adjustment of the deficits, one reason I would put is that we should prioritize the corporate sector, the leveraging of the corporate sector, before the leveraging of the fiscal of the governments, and because we have off-balance sheet liabilities of the government sector, which has insured these loans of the banks to the corporate sector. So if these loans are not repaid, then it's back to the government. So we should avoid this risk at least. Things are going quite well at this stage, but we don't know later on. So we should absolutely avoid a second dip.
I think that's a nice question to ask about the relative sequencing of normalization of monetary policy. Sebnem, do you want to say something to that?
Exactly. I just want to raise three issues and then come to sequencing. First of all, the fiscal space, R minus G, and coordinating fiscal and monetary policy are all extremely related. And I think here we really have to get out of this just US and Europe view, because I mean, literally, I didn't show this figure in my presentation, but if you look at the fiscal packages within European countries and the US, they are not that different. I mean, they're all very big, but we wouldn't get at this, country X has much bigger fiscal package and fiscal space, country Y is much less, so there's going to be all this. I don't think this is something we can really see in the euro area and comparing to the United States. Euro area has other issues, but I think that is very visible when you look at the emerging market. I mean, emerging market fiscal package and fiscal space, versus the rich world is just like orders of magnitude different, which makes fiscal space a number one issue here, right? So that is very important, and we really understand the importance of that when we look at the emerging markets. Now, the second, R minus G, the same thing. Ricardo said in US we had R less than G 200 years, okay, but this is not the case in emerging markets. They were enjoying some low rates thanks to these ultra expansionary monetary policy in the US after 2008. But now we are in a very critical juncture. And in fact, we look at this exact question, that uncertainty Olivier Blanchard showed in the last part of his presentation in our 2021 Jackson Hole paper. R star is a global rate, right? And we did counterfactual policy scenario simulations where, in fact, if this much fiscal policy kept going on in the advanced countries with the recovery combined, there's going to be an increase in R star. So if it is just the recovery, then R star is going to increase to an extent that you still have R less than G. But if we keep adding the fiscal policy on top of that recovery, then we are going to go global rate R star, going to go to a level much bigger than G globally. And for emerging markets, they are going to completely crash and burn from that. Why? Because of differential risk premium. The risk premium is important for everyone, but it's super, super important for emerging markets. I showed this very clearly in my 2019 Jackson Hole paper. We update those results in the context of R star and tremendous fiscal policy in advanced countries in the 2021 Jackson Hole paper. And the risk premium increase in emerging markets in a scenario of recovery, very fast recovery in advanced economies, plus still ongoing fiscal policy, plus no monetary policy normalization by Fed because of the inflationary concern. That's a disaster for emerging markets. And I don't think we want an emerging market crisis in our hands right now. If just five of them start collapsing, there's going to be a huge spillback effect on advanced economies. I mean, I normally I don't worry as much as Ricardo, but if I worry about one thing, it is this. It is an upcoming emerging market crisis. If we keep on this huge fiscal stimulus in advanced countries, that is going to put upward pressure on R star, together with this very fast recovery. And on top of that, Fed is reacting by increasing the nominal rates because of the inflation concern. So I think it's very important. Now, final point, linking it to coordination. I fully agree that, I mean, there has to be a mix, but it can, they should stay separate, as Agnès and Olivier said. I mean, the big thing about this fiscal dominance issues, where we have done very seriously in emerging markets and not that much in advanced economies because of central bank credibility. You have to keep independent central bank and central bank credibility, monetary policy credibility. That's how the entire thing works. That's how forward guidance works. That's how QE works. Why, when advanced economy is doing QE since 2008, nobody uttered the word of debt monetization. And the minute emerging markets now started doing it, the first word we uttered, debt monetization, fiscal dominance, right? Why? Because there isn't that much policy credibility. There isn't that much central bank independence in the emerging market world. So I think we have to be very, very careful here that, they are going to stay separate. But of course, they now we discover this enabling role, which is great, the synergy between them, that should stay. And finally, sequencing. What does it mean in sequencing? And again, I think we should do fiscal tapering. Again, this is especially for large fiscal space, large fiscal package countries, which is basically US and Europe. I mean, fiscal policy did its job. Fiscal policy did normalize demand, did allocate demand to the demand deficient sector, did sustain employment, reduce unemployment. So what more, and prevent firm bankruptcies. What more is there for fiscal policy as a response to COVID to do? If we keep this going on, there is going to be an upward pressure on R star, and through risk premium, it is going to be disastrous for emerging markets. So first, fiscal has to be start tapering, then monetary. Within monetary policy, I think that should be slow and very, very well communicated. We don't want to have another 2013 taper tantrum in our hands. And the order there, I fully agree with Agnès, right? We have to first reduce the balance sheets, central bank balance sheets, because that is like a hidden risk in the background. And then the last thing, so fast fiscal tapering, reduce the central bank balance sheet, and then come to increasing the interest rate. Monetary policy, those short rates, in advanced economies, we always think them, okay, they are short rates. And I agree with Olivier Blanchard. I do want to go to a world where we have nominal rates around 4 or 5%, so we have room. I fully agree with that. But if it is done in a not well communicated way and in a very fast way, it is going to, be disaster for emerging markets, because emerging market risk premium actually works through short rates, not through long-term premium, because they borrow short. So, and U.S. monetary policy has a very large footprint there. So that's, I think, the best sequencing right now, based on what we know. Things, of course, can change, but based on what we know.
Thank you, Sebnem. I'm very conscious about time. We have exhausted our hour by now, but I'm happy to overrun for 5 or 10 minutes to take a couple of questions from the floor. Unless Ricardo wants to absolutely respond to this point.
I want to add one thing to Sebnem, which is really not a response, but let me say, making concrete her point. Just think about Brazil in the next 12 months. There's an election between Lula and Bolsonaro, not exactly paragons of credibility, and certainly fiscal responsibility. If it's a country where the epsilon variant is going to show up, it's probably Brazil, given how large the pandemic has gone. It is still, the economy is still not recovering. And if we have an increase in interest rates and or a QE taper tantrum in the US due to inflation getting out of hand, it is exactly to Brazil that one would look for those restraints to come. So if I'm looking for a place where the fiscal crash could happen, I'm looking at Brazil over the next 12 months. But again, I think all I'm doing is giving you a concrete example to Sebnem's points.
Thanks. Are there any questions from the floor?
Everyone's exhausted.
It seems like everybody's tired after a day like this. Yes.
So I was thinking in this play out of the leveraging, the sequence between the private, the public sector, the banking sector. Everybody needs to deleverage, but there's still like a huge need to invest in order to mitigate or to avoid the financial, the climatic catastrophe, or to adapt for it. So how do you see this in the medium run? Is there a tension there present?
We should increase economic activity and decrease it simultaneously.
Gilles St. Paul proposes to increase and decrease economic activity at the same time. I think it's a very good proposal. Agnès, do you want to respond?
Because this is a fundamental question, and it brings us back to the initial question about the legacy of the crisis. And one topic we have not addressed is the composition of aggregate demand, whether there may be some structural change in this composition with possibly less consumption, more investment, which is fine, but then within investment, whether it's going to be private or public investment. So if we are not serious about, say, the pricing of carbon emissions, then probably private investment will be too low. So this will mean that it's going to be excess savings in the private sector and excess deficit in the public sector. So how? So and here we move to the other topic we've addressed, whether this is a permanent feature where households will permanently lend to the government, and the government takes care of the transition, and this is fine, and interest rate stays low, but maybe a bit higher because there's more debt. Or so what is the long-term implications in terms of macro aggregates of this transition? I think we have not thought about it very deeply, and it can have impact. It can have implications also on taxation, but on R-star, on many things. So we don't know.
Yes, Olivier.
On this point, maybe on the private sector, I'm less worried than Agnès, because if you look at the private sector, I'm not sure that we need some kind of deleveraging, because there will be a decline in the gross debt, but at the same time there will be also a decline in the cash holdings. And in terms to finance investment, if I take the example of France, we have recently published our forecast, what we see is that the corporate sector is perfectly able to sustain a very high, currently the investment ratio is at a record high. At the same time, corporate savings is also at a record high, and profit margins are also very high. That means that we can, the corporate sector can finance a strong investment just through its through its earnings and its cash flows.
We're talking about France now.
So yeah, so I would say the problem of deleveraging is more on the public sector than on the private sector.
R-star is low, because savings are very high relative to, we think, either investment opportunities or the ability to channel those savings relative to the investment opportunities. Over the last 10 to 15 years, those savings have gone to debt contracts, maybe because people are very risk averse, maybe as a result of regulation after the global financial crisis, but they've gone to debt contracts. If, as you say, we should be doing more investment in climate change related investments, who says that that investment has to rely on debt financing? It can perfectly rely on equity financing or capital investments, in which case deleveraging is perfectly consistent with a world that you envision where we have to do massive investments in this new technology. It's a separate issue. There is no lack of savings to invest in climate change or other kinds of technologies. There's no lack of savings. There's excess savings in the world. It's just that those savings right now are going to fund governments in debt and corporations in debt, as opposed to going as equity financing to the projects that you want. So I don't think there's any inconsistency between the deleveraging and the investment in those climate. And then on the climate perspective, I recently was very influenced by a study I saw of, I had in my mind the Elinor Ostrom Nobel Prize showing that collectivism was often an answer to climate problems to protection of tragedies of the commons. And yet there's been a lot of research since Dr. Ostrom received her Nobel Prize, and there was a survey of 113 empirical studies that found overwhelmingly that one of the best ways to protect the environment is to give and enforce property rights. That reduced deforestation in many places in the world and others, because once you tell me that I can protect my plot of land and that I can resell it for a price, I internalize whatever damage I do to it. So there's also a sense in which we tend to think of climate change as having been perhaps too influenced by the externalities debate. We need to collectivize everything, we need to do public investment. Maybe the best way to do climate change is simply to have better property rights, including potentially corrective taxes, including sales, and then let the private sector deal with the climate sector. So again, not only does climate does not require leveraging, it doesn't even require necessarily public investment, or at least it's not obviously at all that it does.
Perhaps we should think about making this topic one for another policy panel here with these speakers and perhaps some others. But for now, let me thank our 4 speakers for some excellent and very stimulating ideas on the macroeconomic and policies challenges, after the pandemic, hopefully after the pandemic. Let me thank Sebnem in Washington, as well as Agnès, Olivier, and Ricardo. And yes, that was the last session of today. For those that want to come tomorrow, we start at, I believe, 9 o'clock. And now I think we've all earned a breath of fresh air. Thanks again to Sebnem in particular in Washington. Bye-bye.